And welcome in, everybody. Justin Vieira, Keller Williams Realty, here in Sacramento, in the East Sacramento Midtown office. Here, joined inside our first actual real estate show. We're not talking about real estate. We're going to be adding a lot of value in talking with really smart people like John Lockwood here. For those of you that don't know us, John and I actually go back a ton.
Yeah, 7th grade.
7th grade, yep, grew up together, went through college, and John's really actually one of my first inspirations in terms of becoming an entrepreneur and a business owner. And together we've done some great things in our cities. And so we brought John in to talk to us about financial planning.
Yeah, thank you.
Yeah, John can talk a little bit in a second about where you're at and what you're doing. And actually, why don't you just go ahead and do that?
Sure, absolutely. Hey everybody, John Lockwood here, financial advisor. I work for a company called Genovese, Burford & Brothers. We're the largest locally owned independent financial advisory firm here in Sacramento. Man, that's a mouthful. Anyhow, what we do is we help people make really good decisions with their money, and we like to help them grow their money. We like to help them do planning for purchasing things like homes, businesses, residential, commercial properties, planning for their kids' college, gifting and inheritance. So all sorts of topics as it relates to financial planning. So happy to be here today and looking forward to hopefully giving you some good ideas or ways in which to help make your money work harder for you.
Great. So one of the things we want to talk about since it's the season is kind of holiday spending to make sure that we don't kind of go crazy and get our goals for the year, blow them out right at the end of the year.
Yeah.
And then talk a little bit too about, some sort of places to start with financial planning and maybe some higher level tips for our clients and audience out there that maybe has already done a few things.
Sure.
And, maybe is kind of making that second or third step. So.
Okay, fantastic. Well, some of the smartest people that I've studied from have taught me two key factors in financial success. One is living beneath your means. So regardless of your cash flow, you need to figure out what's going out every month to make sure that you're not spending more than you're bringing in. And if you could do that, then you're going to put yourself in a great position to be able to put money to work for you in different sorts of asset classes. So we'll talk a little bit about that. But I think the crux of this season in financial success is all based upon really good planning. And I use that word instead of budgeting because when I hear budgeting, it makes me think of spreadsheets and falling asleep depressed.
Sounds like a diet.
Yeah, exactly. No one wants that.
Yeah.
However, planning is visioning and really building your life by design. What do you want that is really going to help you be your best you? And then we just start boiling that down to, this unlimited list of wants to what do I really need and what are a few things that I want so I can make sure that I can live underneath my means or beneath my means, right? And then start acquiring assets so I can build this balance sheet that's going to support me later on in my life or help me with my charitable endeavors or, helping, my kids get educated or whatever your own goals and objectives are. It all starts with planning. So when we think about this time of year, Justin, this is an emotional time of year, right? It's my favorite time of year because we get to reflect on how blessed we are. Yeah. All the amazing things that we've been blessed with, our health, our life, our business success, and most importantly, helping people. So this time of year, it's really hard to rein in the budget because everywhere you go, there's a deal, right? There's a deal here, there's a deal there. And everywhere you're thinking of, oh, this would be really cool for Justin. He'd like that. Or you know what? My next door neighbor, they knocked on my door, told me I had a flat tire before I had to go to work. That's really cool. I want to reward them. You just have to keep things in perspective. So my number one tip to survive the holidays is make a list of everyone you just want to thank for being a great person in your life.
That's great.
The next is create a list for the people in which you really want to give something to, whether that's an individual or a corporation or charity. Make that list. And then you're going to need to do some homework to figure out how much you're willing to spend during this holiday season.
Sure.
And then you just simply have to divide it amongst the people in which you want to give something to.
Yeah.
Right? And the biggest mistake that people make is not counting for the extra costs associated with a gift. These are things like taxes, right? Shipping. I spent like $12 on a gift bag the other day.
Right.
It almost doubled the price of my gift.
Or a $10 gift card.
Yeah.
Yeah.
And then,
or the greeting card.
Then what do you put it in? You put it in a card, you put it in a box, and before you know it, you're $20 out the door, and that's one less gift you can buy. So just really be conscious of your total cost of your gift.
Great.
Yeah.
Anything else on that note?
Yeah, from a budgeting perspective, there's a philosophy that I like to live by, and I like to encourage people to develop their own philosophy. Mine happens to be my birthday of 10-10-80, and what that is take that back. I save 10% for my long-term financial health. I give 10%, and then I live on the rest. So having to create this environment to where only 80 cents of every dollar that comes in can support my lifestyle helps me keep that in check and make sure that I'm taking care of myself financially first, then those less fortunate. So try to figure out what your ideal ratio is of what you save, because you got to do it first, what you give, and then what's left over.
Great. So that goes back to being really intentional about your money, having a good plan, and really living a life by design instead of just kind of by default and by emotion in this season, and maybe getting off track or not being able to accomplish those goals that are really more fundamental to our financial health.
Right.
If you will.
Yeah, absolutely.
Great. Well, another reason that we wanted to have you in, John, is in our world, we meet with so many people that are thinking about buying one of the biggest purchases, or maybe even selling a property that's a really large asset for them. And so they're making this big decision, and they want to make sure that that's a sound decision relative to the total umbrella of their financial picture.
Right.
And so oftentimes the conversation sort of starts for us in the sense of, well, I want to get in the market, I want to buy a home, I want to sell a home, but I need to talk to a financial planner. And so we wanted to have you in too, and just kind of talk a little bit about, do you have those conversations with people, and where should people kind of think about being before they take that step, or maybe how could they know that they're in a great position to take that step if they can kind of already, maybe they're already kind of feel like they're doing some things, but they just need that extra, voice from an expert to kind of feel like, they're making the right move.
No, absolutely. I think it comes down to this philosophy of trusting but verifying, right? You're trusting that you're in a good position, that you're making a good decision, but you know what? Verify it. Talk to a professional. Make sure that, your I's are dotted, your T's are crossed. So, when it comes to buying a home, this is one of the things that I'll just relate this back to emotion.
Yeah.
Right? Anytime you make this large purchase, you're so emotionally invested that sometimes you get blinded by that emotion and you end up making decisions that may not be in your best financial interest. So what's really important to do is to figure out, again, going back to planning, what is your budget? All right, you really need to boil down annually what's coming in, quarterly, monthly, weekly, even to the day. If you can realize what your budget is, you can really start determining, what size of home that you can actually afford. That number one, you're going to enjoy, you're going to love, but secondly, that you're still going to be able to enjoy your life. You'll still be able to take those vacations. You're still saving 10 to 15% of your income in addition to your real estate purchase. I think that's really important to maintain that health. So one of the things that we typically look at when we do planning is not to spend more than 35% of your income on your actual mortgage or rent. Okay, so if you stay under that threshold, it still allows you to have additional resources to make sure that if you're buying the home that you're paying the taxes and the insurance inside the escrow, so it's automatically written every month and you're not surprised with another bill annually or semi-annually for that insurance and taxes. But then also making sure that you can actually furnish the home. That's one of the biggest mistakes people make, is we get this idea that, maybe I can afford that, and especially in today's market, right? We have a complete seller's market. People are getting in bidding wars. What's an extra $10, $15, $20, $100,000 if I borrow it, right?
Yeah.
Well, that might mean the cost of furnishing your home.
Right.
But there's no way you're not going to
repair.
Right.
Yeah.
And that's the next point, is how do you do the repairs and the maintenance and the upkeep?
Right.
So if you try to figure out what size home you want, you've got to determine how much is it going to cost you to actually furnish this home. So if it's your first time home purchase, you're probably spending a lot of dough, right, at IKEA and Home Depot and all of the places in which you're going to furnish this home. So it's important to make sure that, after you're in the home, there's a lot that you've got to take into consideration.
Sure.
Right? Are you going to do the work yourself on the lawn? Sorry to interrupt. Yeah. Are you going to hire the landscaper? Right? Because those are all costs that sometimes we don't think about.
Yeah. Is there any kind of like placeholder or kind of like mile marker that someone should feel like they've hit from like maybe like a retirement savings or planning before they decide to buy a home, or are they interchangeable, or what's kind of your approach or advice on that kind of, because that's where I think a lot of people are out there like, well, they want to do that investment or make that, move up, but, I also want to account for retiring one day. And,
That's right.
And how do you square those two goals? Because they're both seem sort of perilous in a sense to kind of do both at the same time,
right?
For a lot of people.
Yeah, and giving, the incredible growth that we've seen in the California, residential real estate market,
Sure.
Sometimes people think of their home is their retirement.
Sure.
Right? And it's really important to think of the philosophy around, do I save for retirement? Do I buy my home? Is the thing? It's the same. It's not a or, it's an and.
Right.
You've got to do both.
Right.
Right? Because at the end of the day, you need a place to live. Right? So your primary home is the roof over your head. However, if you're going into that purchase with the mindset that maybe this is going to be a long-term rental property for you, then maybe you can factor that into how that plays out in your retirement plan. But it's really important to make sure that you're maximizing every opportunity, especially from a tax perspective, to save for retirement, right? So if you're self-employed, you should certainly be looking into a solo K, right? Or funding IRAs or Roth IRAs. And if you work for another company who sponsors a plan, make sure that you're maxing out those 401k options, especially if they're matching your contributions. So if there's a tax incentive, you really got to make sure that you're maximizing that, because we live in California, and as we're seeing right now, tax reform is happening.
It's gonna change.
It may or may not be in your favor, this new tax plan. So any chance you can to find pre-tax ways to save money, certainly do that. And then you have to build in your cost of housing in addition to that.
Excellent. I like that. That's really powerful. It's not an or, it's an and.
It's an and.
I think that's a really big takeaway.
Right.
I'm sorry.
Oh, yeah, just a thought here, because some of you out there who have these 401k plans, your employers might allow you to actually borrow money against your 401k to purchase the home. And that's not always a good thing. It's not always a bad thing. It really just depends on your overall situation. The good thing is that you can typically borrow 50% of your balance up to a certain threshold based on your plan. Sometimes it's even like $50,000. Okay? And you pay that interest back to yourself.
Right.
Rather than, giving it to a bank. The problem with that is once you borrow money from your 401k, you're locked out of contributions moving forward, meaning that you actually can't save money.
Sort of frozen.
Yeah. And so that really can limit or prohibit you from reaching your retirement goals if it takes you 5 years to pay back that loan, which is the longest that you contractually can repay that 401k loan. So if you miss 5 years of retirement savings contributions, it really can set you back.
Sure, yeah. So we talked a little bit about off camera about a few tips for maybe some of our more advanced client or audience. And along the lines of retirement, we see a trend lately where we have people with high balance retirement accounts pulling money out to acquire like income property, whether it be like 2-unit or 4-unit properties like that. What's some of your sort of takeaways, or maybe any other advanced tips that you'd like to share?
Yeah, I think that, in general, real estate's a great investment. So I would never tell anybody, it's not a good idea to do that, right? Because it's all relative, and it depends upon the individual's goals and objectives, right? If you want to be more hands-on, the real estate's going to empower you with that, right? But if you keep all your money in the stock market and you're not too savvy as far as stocks go, you may not really enjoy that type of environment. But I think for the higher net worth, sophisticated clients, what they're really considering is, what's the rate of return that I'm getting on my different asset classes, right? So asset classes can be real estate as one classification of an asset. A large company stock, a small company stock, a technology type of stock. These are all different classifications of assets.
Look back after a little technical difficulty. Facebook shut us down.
getting too much free advice here. They're cutting me off.
too much value.
Right.
All right, so we were just sort of wrapping up on some of our higher wealth clients that just really need to focus, it sounds like, on, what's the exact sort of dollar in, dollar out performance.
That's right. The internal rate of return is the key. But probably most important to understand is liquidity risk, okay? Meaning that if you buy a piece of property, right, it's not going to be liquid in 3 days. Well, depending on the market is.
Yeah.
Right? So what that means is that there's some liquidity risk, meaning that if you say, hey, look, I need my money on day one, you really have to plan for how long it's going to take in order for that money to come in. On the other hand, if you were to have your money in a bank account, there's no liquidity risk, right? You just run down to the ATM, push the buttons in, there's your cash. Or go inside, right, and you grab your large withdrawal. So liquidity risk is a premium, right, that would require a higher internal rate of return when you're comparing like asset classes. So for example, if you were to buy a stock that paid 8% rate of return versus a piece of real estate that paid 8% rate of return, right, on an equal basis, the stock would have more value because you can liquidate it in one business day.
Right.
Okay? So when you're searching for investment grade properties, you really need to make sure that your IRR accounts for the fact that there is some liquidity risk there, and you should expect that, right, when you're doing your pro formas and your calculations.
Yeah. We always talk to our clients too about being really long term with that, actually, just in case, because you have to be one for even tax. Your minimum liquidity risk is probably 2 years because of taxes for most people. And so just having that really long-term approach and, just make sure that building it all in. And hopefully we're growing from maybe a 6 to a 9 over time or something like that.
Yeah, no, absolutely. In real estate, especially in California, the Sacramento market is completely on fire, as you probably are reading and you're looking at year-over-year growth rates. So regardless of what you read in the financial newspaper, it's really important to make sure that that investment is appropriate to add another piece onto your portfolio. So we just encourage you to have someone take a second look at it for you.
Yeah, that's great. Well, great. I got so many good takeaways. A really big one was, removing a lot of emotion out of decision making by being planned. This is a great time to be thinking about your 2018 plan.
Absolutely.
And then taking some of those discipline items for next year's holidays. So we don't blow it.
Right.
I think that's great. And then, trust and verify. I thought that was really, really powerful. Goes along with being planned. And then about real estate not being an and or kind of situation. Real estate and the retirement is more of a and than
absolutely. Yeah, they work together.
Really like that. And then for our clients that are out there paying a ton of money in rent, looking at that 35% ratio and seeing maybe if we can find them a home that's maybe below that, or at least having a good idea of what makes sense from a professional level in terms of advice, and then then you're within your own sort of delta, if you will, on maybe it's a little bit higher, maybe it's a little bit lower, depending on what your ultimate needs and goals are.
No, absolutely. I couldn't emphasize more that the quicker you can get into an ownership arrangement, meaning to buy your home, the faster you're growing your balance sheet. Right? So even if that means you start off in a much smaller home that potentially, is not your dream home, you've got to do it.
Yeah.
Right? And the opportunities for smaller priced homes are fewer and far between, so it's really important that you consult with your realtor to make sure, right, that Justin's going to find you a great place for you to start. And then, of course, just make sure that you're not spending too much of the discretionary income you have on your home.
Yeah. We're a big preacher, or we preach a lot or heavily on long-term affordability, so that so our clients are more in control of the market than vice versa. So we find that to be a really powerful strategy. So yeah, I totally agree. Yeah, that's great. Well, John, I really appreciate you coming down, spending some time with us.
Thank you so much.
Yeah, this is awesome to kick off our first show. We don't even have a name for the show, but we're just trying to add value to our clients and our audience, and
awesome.
And hopefully we'll have you back next year and maybe give us a little update in financial services.
Yeah, sounds great. I'd love to do it.
And maybe we'll have a name for our show by then.
All right.
Awesome, all right, thanks everybody.
Thank you.
All right.